Economic activity moderated in June. That's according to the findings of the BankServe Africa Economic Transactions Index, which dropped by 0.5% to just over 135. The automated clearinghouse has cited a reduction in temporary employment post-election, uncertainties surrounding the election outcome, and the establishment of a new political dispensation. Despite the performance, BankServe Africa is optimistic. It says the print is nearly 2% higher than March's figure, and this indicates that the second quarter growth should be in positive territory. The Reserve Bank's taken a near 1 billion rand hit on its African Bank Holdings investments. In its annual report, the SARB says the lender's performance declined in the current financial year and resulted in a more conservative outlook on estimated future cash flows. The impairment means the Reserve Bank's 50% stake is worth around 3.5 billion rand. That's almost a fifth lower than the same time a year ago. The lower assessment of African Bank's value comes at a time when the Reserve Bank is preparing to offload its stake in the lender via an initial public offering. The IPO will complete the bailout of African Bank, which collapsed under the weight of unpaid consumer loans in 2014. Pick n Pay says it's proceeding with its 4 billion rand rights offer, and the terms are set to be published tomorrow. The rights offer is part of the group's recapitalization plan to get the business back to profitability. The net proceeds, combined with that of the proposed Boxer IPO, will largely be used to settle the group's outstanding debt and for reinvestment to secure the turnaround of the Pick n Pay supermarket business. Teresa has posted a rise in third quarter chrome and platinum production, citing improved mining and plant recoveries. It's added that PGM prices for the period were at slightly higher levels than the previous quarter, supporting the market view that the bottom of the market has passed. Chrome prices, meanwhile, continued to trend upwards on strong fundamental demand. CEO Phoevius Perolis says Teresa's focus on sustainable mining, coupled with its structural improvements, positions the company for a strong final quarter. Alphaman Resources has shot the lights out. The miner says tin production for the second quarter has hit a record high. Output for the period came in 28% higher, and that's been attributed to the Mpama South expansion. Alphaman says only half of the quarter benefiting from the expansion, and it therefore expects to see a further increase in production over the next 3 months. On the international front, fast fashion retailer Shiin has pledged a €250 million investment over 5 years in the UK and Europe amid criticism for its business model of flying inexpensive clothes and accessories from Chinese factories directly to global shoppers. Here's more detail in this package report.
Shiin is trying to win friends ahead of a possible share sale. The fast fashion giant has pledged to invest in the UK and Europe. It's promising to put in about $271 million over 5 years. The move comes as Shiin runs into opposition ahead of a possible share listing in London. It's faced criticism over labour standards in its supply chain. European politicians also accuse it of killing local firms by flooding the market with clothes at rock-bottom prices. Some say it's exploiting a tax exemption for low-cost parcels, a loophole the EU is now thinking about closing. The China-founded firm was valued at $66 billion in a fundraising round last year. It already sources some clothes in Turkey, but gets the vast majority from China. Speaking to Reuters, Chairman Donald Tang wouldn't say where in Europe it might now start sourcing goods. The firm said it would bring more European artists and designers into its incubator program as part of the new investment. Reuters sources say Shiin filed papers last month for a potential London share sale later in the year. However, the Financial Times has since reported that the firm is keeping alive the possibility of a Hong Kong listing too.
And Germany has continued to see a rise in insolvencies among medium-sized and large companies in the first half of this year, attributing this to inflation, rising costs and weakening demand. Here's our reporter Anatin Devu with more. And that's right, Ndao, insolvencies among German businesses have indeed increased in the first half of this year. In fact, reports are saying that this rise is actually higher than expected in the country. And for more on this, I'm joined by DW correspondent Chiponda Chimbelu. Chiponda, thank you so much for your time. It seems that things are getting worse than better. So what's the latest on this?
Thanks for having me. Well, the number of insolvencies has reached the highest level in nearly a decade, and more bigger companies are becoming insolvent. So these are firms with a revenue of more than 10 million euros. There were 41% more insolvencies among such businesses in Germany in the first half of this year compared to the same period in 2023. Now, that is, of course, according to Germany's Business Daily Handelsblatt, which cites data and analysis by consultancy firm Falkensteg. The worrying trend isn't just the rising number. Insolvent companies are also less likely to be rescued. Even big names such as the department store chain Galleria and the fashion brand Esprit. Only around 1 in 3 companies that became insolvent this year could be rescued. Now, that's according, of course, to the report. That is much fewer than, say, 3 years ago when more than half could be saved. And experts say investors are holding off saving companies because they expect the number of insolvencies to continue rising.
Chiponda, tell us, how is the trend playing itself out in the different sectors in Germany?
Well, the auto industry and retail are among the worst affected sectors, and car makers are undergoing structural change as the sector shifts to producing more electric vehicles. So auto suppliers making parts for combustion engine vehicles in particular are facing challenging times. Meanwhile, retailers are increasingly facing more competition from e-commerce, and that is making it harder for them to remain competitive. And the worst affected sector is construction. Insolvencies for construction firms with a revenue of 10 million euros or more jumped. There were more than 200% insolvencies in the first half of this year compared to last year. The construction industry has been struggling with high interest rates, rising building costs, supply chain issues, and a drop in demand. And the hesitancy of investors to make any major investments isn't helping. So the lack of liquidity is leading to more insolvencies for the sector.
Construction is quite a significant sector there, Chiponda. Tell us what this means for the German economy.
The fact that many construction companies are becoming insolvent isn't helping solve one of the country's biggest challenges, the housing crisis. The latest figures show that rents in Germany's biggest cities have reached record levels, according to data from property listing site ImmoScout24. The housing market isn't keeping up with demographic trends. For instance, the fact that 1 in 5 Germans lives alone, and these individuals are also spending a bigger proportion of their income on rent. That is, of course, leaving more and more people with less spending power. And the tight property market is also a headache for businesses. Hiring workers isn't the only challenge they face. New workers may also need accommodation, especially if they're moving from somewhere else, like, say, another country. And the housing crisis, a tight labor market, high interest rates, which are hurting investment, of course, are all making Germany a harder place to do business. And the recent jump in insolvencies is, of course, just the latest sign that Europe's biggest economy faces years of slow economic growth.
Well, let's leave it there for now. Chiponda, thank you so much for those insights. That was DW's correspondent, Chiponda Chimbelu.